Yo, what's up, boys? Kyle S. back here with another video of Kyle's Trader Academy. We are going to explain liquidity pools. So, liquidity pool is something that institutional traders, which is what you should aspire to be if you trade. It's where institutional traders enter, and or smart money basically enters whenever retail traders or people who just are emotionally trading whenever they exit because they get stopped in the form of stops. So it's usually when price runs stop. For instance, if there's a bunch of lows, there's a bunch of highs right here. All of this, creating these highs is all accumulation right here. Price comes down. They're like, okay, yeah, definitely we're going down right here. They might even be re-entering because they're fucking emotional, trying to get a quick buck. Comes back up. This scares the shit out of them, but they're like, oh, it didn't take this. They might even re-enter more here. And this little move right here, this is called a turtle soup. And a turtle soup is a form of a liquidity grab, and can be used as an entry confluences, but it's more so an entry confluence, but it's more so about narrative. So this can be a tell of like what the market's trying to tell you. So we'll look at another form right here. So something like this, right? This big move up right here, you can scale down usually on the 1 minute and see what usually happens. So we have a bunch of higher highs, higher lows forming, creating a little trend. It's not a very strong trend, but people are thinking short bias here. They're not looking at the high time frame, looking at anything. They look at something like this and they're like, okay, cool. They see price coming up here. They're trying to predict a reversal, which is what a lot of people do wrong. And then maybe right here, they try to go long. Price comes down one more time before it goes up. It's not always one more time, and sometimes it never even happens. But a lot of the time, it happens. A manipulation leg will usually happen right before a distribution leg. So this is all accumulation. Price is accumulating orders. Right here, definitely accumulated a bunch of orders. And then I'm willing to bet you right now that anyone who entered right here, or maybe off a retracement of this fair value gap, I'm willing to bet you their stop was right there. And it got perfectly ran. Then what do you see? So institutional traders, here's what we see. We see shit like this. And we see it sweeping lows. We might even see it sweep more lows. We wait for something strong like it to come up quite a bit. We have strong displacement here. I don't even really see an entry here. I probably wouldn't have even gotten into this trade. I'm not even kidding you, because in my mind there's no. But it doesn't matter. This is really about narrative. Liquidity pools are not necessarily an entry confluence. They're more so just tying it in a narrative. So don't really think of this like an entry. Think of it more so like, why are retail traders getting stopped out? Because they're emotional. Price is coming here. They enter long. Oh shit, it's going to stop them out. That's where their stops are. So basically you need to think, where are retail traders placing their stops? Wait for that to get ran, and then in the form of some sort of turtle soup or something. And then that can help tie in your narrative for how you look at this. They saw an up close candle. A lot of people, they just jump at this first up close candle, right? The target's maybe right here, and their stops are like right here. Perfect wick. This is called a turtle soup. I know it sounds stupid, but this is called a turtle soup right here. Shit. This is called a turtle soup right here. This wick right here is the turtle soup. I don't know why they call it that, but basically it's kind of like a liquidity grab. So price comes down and stops people's resting order. It stops traders out before it distributes up. That happens a lot. Right here before this big move down, we had this. This isn't the best example, but maybe something like right here. Like I said, it doesn't always happen. That's why you don't place trades if it doesn't happen. But this is part of the narrative. This right here is a great example. We have highs being formed. We have what looks like a displacement candle, but it's really a manipulation leg. Coming up, failing to trade above this. A lot of people are probably entering somewhere right here. And I'm going to bet you their stop is right here. You need to think how they would think. They would put their stop right there. They'd see it come up, maybe try to get a good entry. Stop would be right there, because they're just entering way too fucking early. Maybe trying to take this order block out. Doesn't matter what they're fucking going for. This right here is the reason why they're getting stopped. This right here, and then it goes down. You see what I mean? Because look, if you go back on the 1 minute, where is it? I'm gonna assume this is it. if you go back on the 1 minute, you can see what happened here was maybe they saw these higher lows and higher highs getting created, and they saw a break of structure, which is different from a market structure shift. They might have thought this was a market structure shift. I was like literally recently explained that there's actually a difference between market structure shift and break of structure. This is a break of structure. It's not a market structure shift, because there's not a lot of strong disrespect from this. This is the 1 minute chart, guys, and this is the problem, because a lot of people just stick on the 1 minute chart and they don't actually realize high time frame narrative matters. This is a tool that I'm giving you to help explain to you high time frame narrative, and I'm explaining. So this right here, this is where people are getting stopped out, because this is the last swing, higher swing high that was created, and they find maybe some sort of entry. Maybe they entered like at this wick right here when it was coming down, because they thought there was some sort of reversal because it closed below these lows. These are 1 minute lows, guys. This doesn't really matter that much. Price doesn't really give a fuck about that. This would be something that's more considerate, right? Or maybe this low was created and then price created higher low. Look, even more manipulation, comes down, takes this, comes back up, gives you a chance to re-enter on this FVG fill. Perhaps this is probably where I would have entered, at the equilibrium of that, and then stops her at this swing high, and then go down here. So I'm going to tell you right now, a lot of new traders, they over leverage, so they use more contracts than they need to, meaning their stop has to be less in tick value as far as range goes. It has to be less in tick value. That's why their stops almost always get rid, because they have really tight stops, because they're like, I don't want to risk shit for this. But they don't understand that it's all about the bigger picture, the narrative. So someone's shit might look like this. This would be probably what an institutional trader's trade would look like, because this is something that's very reasonable. They might enter off something like this and maybe a retap right here, and they might have a 100 or so tick stop right after this happens, and if they get stopped out, they get stopped out. But they have entry confluences that they pair with it. So at the end of the day, a liquidity pool is something that institutional traders are looking out for. It's a big mistake of retail traders, and they're going to continuously take advantage of them, because price is going to take their money so it can distribute to a new price every single time. And you'll notice this a lot during New York AM, New York PM, or London session. This is New York PM. Let's see here. Let me go to New York AM. New York AM right here. This is the 9:30 open. Okay. This is the 9:30 open right here. This is the 9:30 open. This right here, it played out, but it didn't take their liquidity. But this right here would have got them really close, because their stop would have been right here, most likely, or maybe a little bit above this. This would have been too close for comfort right here. Maybe some sort of entry like this. I'm not worried about their entry. I'm more so worried about narrative. Don't try to get lost in the sauce thinking about their entry and shit. Something like this, it got really close to them because they didn't pick the right entry. You want to wait for this to happen. This is usually a turtle soup or close to it to happen, and then strong rejection off of it. This right here, it ended up closing way the fuck down here. Strong rejection off this. Maybe re-enter here, strong rejection, re-enter here. It doesn't matter. But you're waiting for this to happen, and then considerable lows to be taken. So a large amount of lows, maybe something like this, or even this. Some people might have got in right here. Because at the time, I'm willing to bet you price looks like it might have reversed, but you have to look at the high time frame liquidity grabs as well, because it's going for the high time frame. Price is playing out in the high time frame at all times. But this is not an entry tool. Liquidity pools are not an entry tool. It is a way that it is a form of narrative understanding. It's a confluence for narrative. So the main things here are liquidity pools that are major. It's very similar to a PD array, but liquidity pools are usually where retail traders' stops are, and it's usually in the form of like equal highs. It could be in the form of just a regular swing high, like this is a pretty considerable swing high, come up wicket before this move down right here. All these were really major moves down. This is or minor moves down. This is the major move down. And you look back in the market, you start to connect the dots. It starts to make sense. These really long wicks here are manipulation. This right here, price wanted to take them out. Price consolidated a fuck ton, didn't really do much. Took them out. Look how strong that wick is. It took them out very strongly, and then it started trading down. Then it did it again, and again, and again. So That's why price moves up and down. So at the end of the day, you need to look at the market and identify why price might have done that, and it's usually because it's taking out retail traders' stops. That is a key indication, and that's why I'm making an entire video on that. If you have any questions at all regarding liquidity pools or liquidity grabs or stop hunts, there's many things to call it. Leave a comment down below and I can help you. But that's why I can't stress the importance enough. That's why I'm making a whole video on this, on liquidity pools. Liquidity pools are super, super important. All right, guys, if you have any questions, leave a comment down below, like I said. Like and subscribe and turn on that bell, and I'll see you in the next one. Peace.